Welcome to the International Rescue Committee's video series on buying a home in the United States. This video is divided into 3 parts. Part 1 will go over how to make a financial plan and determine what you can afford. Part 2 will go over how to finance your home purchase, including mortgages and other resources. And Part 3 will discuss shopping for your home. Today, we'll focus on 4 key objectives. First, we'll talk about what homeownership really means, the benefits and the responsibilities that come with it. Next, we'll look at how to create a financial plan for buying a home, including budgeting, saving for a down payment, and improving your credit score. We'll also explore what drives home costs and monthly expenses, so you know what to expect before you buy. Finally, we'll share strategies and programs that can help you save money and prepare for home ownership with confidence. Home ownership is an important milestone. It represents stability, independence, and an opportunity to build wealth over time. Think about what home means to you. For some, it's safety and comfort. For others, it's a place to build memories or invest in the future. Take a moment to reflect on what owning a home would mean for you and your family. Owning a home often means having control over your living space, building equity, and creating a sense of permanence. It's a big responsibility, but also a significant opportunity. There are several types of homes you can consider. Apartments, which are units within a larger building. Co-ops, where you purchase a share in a property rather than owning the unit outright. Condos, where you own your unit and share common spaces and services. Townhouses, which are individual homes that share walls with neighbors. And single-family or multi-family homes, which are standalone properties often with land around them. What are the benefits of owning a home? Owning a home has many benefits. It's yours, giving you stability and control. It helps you build wealth and assets over time. Home values generally rise, and you may qualify for tax deductions. Home ownership also connects you to a community. Owning a home means taking on a variety of responsibilities. You'll need to pay your mortgage on time each month, along with other regular expenses, such as utilities, property taxes, and homeowner's insurance. Beyond bills, you are in charge of home maintenance and repairs. This can include fixing leaks, servicing appliances, maintaining your yard, and making sure your home stays in good condition overall. Essentially, being a homeowner means actively caring for your investment and planning ahead for both expected and unexpected costs. Before buying a home, you need to create a financial plan. Ask yourself, how much can I afford? This depends on your income, credit score, and monthly expenses. Making a clear plan will help you avoid financial stress later. Begin by creating a clear, realistic budget that outlines your income, expenses, and savings goals. Determine the price range of the home you want, keeping in mind what fits comfortably within your budget. Start saving for your down payment and other upfront costs, like closing fees. Check your credit score and take steps to improve it if needed, because it can affect your mortgage options. Explore local programs, grants, or resources that might provide assistance. Finally, put together a step-by-step plan that guides you from budgeting to closing, so you have a clear path to achieving your goal of homeownership. Several factors affect the price of a home. Location has the biggest impact. Home prices can vary widely between neighborhoods, cities, and states. For example, for $350,000, you might buy an apartment in Salt Lake City or a large house with a yard in Wisconsin. Supply and demand also play a major role. During COVID-19, fewer homeowners were selling because they didn't want strangers entering their homes, while low interest rates encouraged more people to buy. This combination made the market highly competitive, driving prices up quickly. Other important factors include land size, which generally increases the price, the overall economy, which can push home prices higher in a growing market, and the condition or appearance of the home, which often has less impact than these other factors. Home prices go up over time. In a healthy market, home prices might increase by 3% per year. Since 2020, home prices in Utah have increased by nearly 30% annually. That means home prices have risen about 10 times as fast as would be considered healthy. There are no professionals who expect home prices to come down anytime soon, and overall, we can see that even when home prices did decline in 2008, they only decreased slightly compared to their previous increase. After 2008, the federal government enacted laws intended to prevent a repeat of the housing market crash that occurred then. So it is unlikely that you will be able to buy a nicer home next year compared to what you could buy right now, unless you can get a job that pays much, much more than your current job. How much does it cost to own a home? Owning a home involves much more than just the purchase price. You'll need to budget for a down payment, closing costs, and your ongoing mortgage payments. On top of that, plan for property taxes, homeowners insurance, and utilities like electricity, water, and gas. Homes also require maintenance and repairs, from routine upkeep to unexpected fixes. If your home is part of a homeowners association, HOA fees are another cost to consider. All these expenses can add up quickly, so careful planning and a realistic budget are essential to make homeownership affordable and sustainable. Home insurance is a policy that outlines what an insurance company will cover and under what circumstances. Understanding your policy is very important because not all policies cover the same things or pay the same amounts, which is why prices vary. Home insurance is usually required by your mortgage company and primarily covers structural damage from disasters like fire, windstorms, falling tree branches, or vandalism. It does not cover damage from normal wear, lack of maintenance, or certain disasters like earthquakes and floods, which require separate policies. Home insurance also provides personal liability coverage, paying for legal fees if someone is hurt on your property and wants to sue, as well as medical expenses if someone is injured and does not pursue legal action. Loss of use coverage can help pay for temporary housing, like a hotel, if your home becomes unlivable. Always review your policy carefully with your insurance provider to know exactly what is covered and how much protection you have. The Homeowners Association is an organization in a subdivision, planned community, or condominium building that creates and enforces rules for properties and residents. If your home is part of a homeowners association, you will be required to pay monthly dues. These cover maintenance, repairs, and shared services. HOA rules can affect what you can do with your property, and dues often increase over time. Always ask about HOA fees before making a purchase. Here's an example of monthly costs. In Northern Virginia, a home priced at about $546,000 might have a mortgage payment of $2,946, property tax of $645, insurance of $198, and utilities around $329. Total monthly cost, $4,118. In Houston, Texas, a $300,000 home might have a mortgage payment of $1,503, property tax of $572, insurance of $105, HOA fees of $52, and similar utility costs. Total monthly cost, $2,561. This shows how location affects both home prices and monthly expenses. A good rule for budgeting is the 50-30-20 rule. 50% of your income goes to needs like housing, utilities, and groceries. 30% goes to wants like entertainment and dining out. 20% goes to savings or paying down debt. Start by saving the 20% first, then manage the rest of your income accordingly. Mortgage lenders look at your debt-to-income ratio, which is the percentage of your monthly gross income that goes toward paying debts. To calculate it, add up all your monthly debt payments, divide by your gross monthly income, and multiply by 100. A ratio under 35% is excellent, 36% to 49% is moderate, and over 50% means you may need to reduce debt before buying a home. When you apply for a mortgage, lenders add up your existing debts and see how much more you could afford for your mortgage payment and HOA fees, so that your total debt does not exceed about 50% of your gross income. Different lenders may have slightly different limits. There are 3 main ways to qualify for a higher mortgage amount. Pay down your debts. Reducing debts frees up more of your monthly budget for a mortgage, increasing the price of home you can afford. Increase your income. Earning more money each month also allows you to take on a larger mortgage. Make a larger down payment. Putting more money toward the home upfront can help you qualify for a higher-priced home, though increasing income and decreasing debts usually has a bigger impact than the down payment alone. Understanding your debt-to-income ratio and managing your debts and income carefully can significantly affect the homes you qualify to buy. A down payment is the percentage of the home price you pay up front. The ideal amount is 20%, but first-time buyers often pay between 5% and 10%. The more you pay upfront, the better your mortgage terms will be. For example, if you buy a $500,000 home, a 20% down payment would be $100,000. Now, why does this matter? A higher down payment comes with big advantages: lower interest rates, smaller monthly payments, and reduced PMI premiums. Over time, that can save you thousands. On the other hand, a lower down payment lets you purchase a home sooner, keep more cash for renovations, and maintain an emergency fund for unexpected expenses. There's no one-size-fits-all answer. The right choice depends on your financial goals and how much flexibility you need after closing. There are programs designed to help first-time buyers with their down payment. These can include grants, loans, and even tax credits. Grants never have to be repaid, while loans are often offered at low or no interest. Some programs also provide forgivable loans, where the debt is erased after a set period, usually 5 to 10 years. Down payment assistance can cover 2% to 5% of the home price and may include closing costs. To qualify, you'll typically need a minimum credit score of around 620, meet income requirements, and agree to live in the home as your primary residence. Many programs also require you to attend homebuyer education classes and contribute some money toward the down payment. There are over 2,000 assistance programs across the U.S., so it's worth exploring your options. Visit HUD.gov or contact your local housing authority to get started. Individual Development Accounts, or IDAs, are special savings programs that help you reach big financial goals like buying a home, starting a business, or paying for education. Here's how they work. The program matches the money you save, sometimes up to a set maximum amount. For example, if you save $10,000, the program may match that amount, doubling your savings. To participate, you'll need to attend financial education classes and counseling. These programs are designed to build strong money habits while helping you achieve your goals. Set a home price range you can afford by looking at 3 key factors: location, your home needs, like the number of bedrooms, floors, or garage space, and what monthly payment fits your budget. Once you have an idea of these, use tools like NerdWallet's Home Affordability Calculator to help you estimate a realistic price range. This step ensures you're shopping for homes that match both your lifestyle and your financial comfort zone. Build your credit before applying for a mortgage. Your credit score has a big impact on your interest rate and monthly payment. For example, on a $300,000 mortgage, someone with excellent credit could pay around $1,081 a month, while a lower score could mean payments over $1,300 and tens of thousands more in interest over the life of the loan. To improve your score, pay bills on time, reduce debt, and avoid opening new credit accounts before applying. A higher score gives you access to better loan options and saves you money in the long run. If you buy a $500,000 home with a 4.5% interest rate on a 30-year loan, your monthly payment for principal and interest will be about $2,533. Over 30 years, that adds up to $911,880. A good credit score saves you thousands in interest. Here's why. Part of your monthly mortgage payment goes toward the principal and part toward interest. The amount you pay in interest depends on your interest rate, and your rate depends on how risky the lender thinks it is to loan you money. They look at your credit score and your debt-to-income ratio. A higher score means you're more likely to pay them back, so you get a lower rate. If your credit score is low or your mortgage takes up too much of your income, the lender sees more risk and charges a higher rate. That means you'll pay more in interest over time. Keeping your budget realistic and improving your credit by paying bills on time, reducing debt, and avoiding new credit accounts can save you money and protect you from financial stress. If you buy a $500,000 home with a 6.5% interest rate on a 30-year loan, your monthly payment for principal and interest will be about $3,160. Over 30 years, that adds up to $1,137,600. Why is this so much higher? A person with bad credit will have a higher interest rate because the lender sees more risk. In this example, the rate is 6.5% instead of 4.5%. That difference adds up. Someone with good credit might pay around $171,000 in interest, while someone with poor credit could pay $279,000. That's a $107,000 difference, just because of credit score. Another way to save money is by paying a little extra toward the principal each month. For example, if the person with the 6.5% rate paid $50 extra toward principal every month, they could save about $37,000 over the life of the loan. You don't want to pay more than you can afford, but if it fits your financial strategy, even small extra payments can make a big impact. Make your home purchase plan by writing down clear goals and steps. Start with your target price range for the home. Next, look at your income-to-debt ratio. Your goal should be under 50%, which may mean paying off credit cards or increasing income. Set a down payment savings goal and track what you've already saved. For example, you might plan to save $400 a month or sign up for programs like IDAs or first-time homebuyer assistance. Finally, review your credit score and set a goal to improve it. Steps could include using credit cards less and paying bills on time. Putting these details into a written plan helps you stay focused and move toward homeownership with confidence. That brings us to the end of Part 1. Today, we covered what homeownership means, its benefits and responsibilities, and how to start planning financially for your future home. In Part 2, we'll dive into how to finance your home purchase, including mortgages and other resources that can make buying a home more affordable. Then, in Part 3, we'll focus on the exciting part, shopping for your home, and understanding what to look for during the process.